Hello, I'm Chris Pedersen, and this is Stock Watch on Wednesday, the 3rd of July, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to me, Chris Pedersen, at stockwatch@fnn.com.au. Here are some of my market observations. I predict that the RBA will continue to look for more data to justify rate rise. In other words, they really don't want to raise rates. And if they can find data that shows they don't have to, they will highlight that. Joe Biden will step aside for someone who can call out Trump on his lies and his terrible policies. ASX 200 will continue in a slow and volatile trend that is slowly upwards. Here is the Australian yield curve. The reason I include this is because it's pretty flat. You look at the 1-year yield, and then you look at the 15-year yield, and it's pretty flat. Yes, there's some variations in between, but overall, this yield curve needs to either have short-term rates come down or long-term rates go up to make it a normal-shaped curve. This is a chart of Asian markets and who's performed best in the first half of 2024. What's disappointing is you look down towards the bottom in the ASX 200 and all the countries that are performing better than we are. What is good about this chart is it shows you where to consider investing, maybe through a country ETF or a regional ETF. I'm including this chart because this shows that spending is a terrible indicator for when a recession is coming. What we find here is that spending does not slow down until after we enter into a recession. This chart shows aftermarket trading in the United States. It is exploding. This is pre-market and aftermarket. What we have here is with the ASX, there's none of this. Maybe we should consider allowing pre-market and post-market trading. This is the French voting turnout. It's been trending down for a while, but with this election, there's so much at stake, it's actually spiked up. That is positive. This is the S&P 500. What it shows is right now it's expensive on a historical basis. This measures forward-looking PE. It's worth taking a look at. What it means is that be careful investing. I would not put all my eggs into one basket right now. Diversify, not just equities, also maybe some fixed income. Here are 3 companies I want to cover today. The first one is Baby Bunting Group. Covered it a few years ago. I've kind of liked it, but it's actually performed very horribly. You look at the chart, it's been in a downward trend. Currently it's trading around $1.53. Let's look at the recent numbers. These, by the way, are from Morgan Stockbroking and Citibank estimates. Market capitalization is not that big, it's only 200 million. However, if you have children, it's a significant store that you go to. Price target is around $1.79. The revenue growth rate for each of the next 3 years is only 4% per annum, but that doesn't tell you the whole story. The earnings per share growth is looking around 14% per annum, and the dividend growth is looking around 8% per annum. Now, I also added in here equity growth. This is shareholder equity from its balance sheet from the 2023 to 2026 estimate, and that's only 2% per annum. So that says that they aren't really growing all that much, or they're paying out all their profits and dividends. Let's take a look. The PE on Baby Bunting, with the 2025 earnings per share estimate 12.5 cents, is 12 times. The yield on the 25 dividend estimate of 8 cents is 5.2%. Free cash flow is 7.5%, and the payout ratio is 65%. So Baby Bunting is Australia's largest specialty store for children. I think it has a very good reach across the country. However, it needs to perform a little bit better for me on a long-term basis before I rate it a full buy. Right now, I like the numbers. I like that it's probably recovering. I give it a half-weight buy. Second company is Origin Energy, code ORG. It's trading on the ASX at around $10.93. Take a look at this 5-year chart. It's phenomenal performance. Is it overpriced now? Let's take a look. These are estimates from UBS, and the market cap right now is 19 billion. 12-month price target, according to UBS, is $12.10. The revenue growth for each of the next 3 years is negative 0.8% per annum. Now, to tell you the truth, when it comes to energy prices, they're so volatile right now that these estimates can change dramatically, but it's a good starting point. The earnings per share growth estimate is 17% per annum, and the dividend growth estimate is 8% per annum. The PE on the 2025 earnings estimate of 77 cents is only 14 times. And the yield on the 2025 dividend estimate of 51 cents is 4.7%. So these are all solid numbers. Free cash flow is 6.5%, and the payout ratio is 74%. Origin Energy is a producer and they're also a retailer. It's a tough space, energy, right now, because our costs are soaring. The government wants to get them down. But today I read an article that Australia might even have to import natural gas, even though we have more natural gas than we ever need. And we're a big exporter to the rest of the world. We might need to import natural gas. That shows you that there's policy problems in Canberra. And Origin Energy is kind of hostage to Canberra being able to sort out our energy problems. Accordingly, I would say that Origin is a buy, but I would wait right now before buying it. Ventia Services. I haven't heard of this company until I saw it last week. The code is VNT on the ASX. It's trading at about $3.86. From a chart, it looks attractive. This company seems to be performing. Canaccord estimates are the ones I use today. Market cap right now is $3.3 billion. The price target is $4.40. The revenue growth rate from 2023 to 2026, the estimate is 6.4% per annum. And the earnings per share growth in this period is 10% per annum, and the dividend growth is around 7% per annum. As you know, I'm a big believer in dividend growth rates. The PE on Ventia's 2025 earnings estimate of 28.5 cents is 13.5 times. And the dividend for that year, the estimate is 21 cents or 5.4% yield. Free cash flow is 3%, and the payout ratio is around 77%. This company provides telecommunication and transport infrastructure in the defense and social services sector. Their clients are governments and blue chip companies. I rate it a buy. You want to learn more about anything covered today? Send an email to stockwatch@fnn.com.au and address it to me, Chris Pedersen. I hope you have a wonderful day. Thank you for your time.